$1 trillion gone. Quietly, completely without ceremony. For years, Chinese capital was a hidden engine inside the American machine. It bankrolled the tech dreams of Silicon Valley. It lit up the skylines of New York and Los Angeles. It funded everything from blockbuster films to biotech labs, startup incubators to steel towers. No one questioned where the money came from. They just knew it came. Until it didn't. There was no speech. No headline. No midnight tweet. Just stillness. One day the money moved. The next it didn't. The flow stopped. Not paused, not diverted. Stopped. The taps were shut off. The oxygen line cut. No sirens, no blame. Just a lock clicking into place and no one holding a key. Inside American boardrooms, the silence hit like a gunshot. Deals vanished. Term sheets crumbled. Phones rang with no good answers. This wasn't a policy adjustment. It was an economic strike, precise, silent, and surgical. A full-body hit to the U.S. financial system, delivered without a word. No tanks. No sanctions. Just capital, pulled like a rug. This wasn't a move made out of emotion. It was cold strategy. March 17, 2025. No front-page story. Just a few buried lines in an obscure regulatory filing from China's Ministry of Commerce. It reclassified outbound investment into hostile jurisdictions. At the top of that list, the United States. Effective immediately, all Chinese capital heading into American companies was suspended. No fanfare, no explanation, just silence. Markets shuddered before the news even broke. Reuters would confirm it days later. But the damage had already started. Capital pipelines that once gushed with billions had dried to zero. Not a freeze, not a slowdown. A kill switch flipped. This wasn't out of the blue. It was the final step in a long retreat. Since 2018, Chinese investment in the U.S. had plunged from $46 billion down to $2.3 billion. Now, nothing. Not a cent. A deliberate withdrawal designed to hurt but not explode. Professor Zha Daojiang of Ping University called it what it was, a financial decapitation strike. A move crafted to apply pressure without provoking retaliation. China didn't want a war. It wanted control, leverage, options, and above all, silence. But behind the scenes, something even bigger was happening. While America focused on tariffs, chips, and sanctions, China was re-engineering its global strategy. Not loud, not fast, just steady. In 2024, it dumped $14 billion in U.S. treasuries, the biggest sell-off since 2016. It trimmed its total holdings to $775 billion. Simultaneously, major state banks halted dollar transactions with American institutions. Officially, compliance updates. In reality, a firewall. U.S. Commerce Secretary Gina Raimondo issued a quiet warning. China was restructuring its financial exposure, reducing its vulnerability, loosening America's grip. And she wasn't wrong. China had already begun rewiring its economy, cutting new deals in Riyadh, in Moscow, in Brussels. European firms, tired of playing by U.S. rules, were looking east. The message was clear. America wasn't the only game in town anymore. And the effects? Immediate, unmistakable. Foreign direct investment into the U.S. fell 22% in 2024. Another 19% drop is expected this year. China's absence is the headline, but others are slipping away too. Norway's sovereign wealth fund quietly pulled $7.1 billion from U.S. tech. Japan's government pension fund slashed its commercial real estate exposure by 30% after American regional banks took a hit. And looming ahead is the biggest pressure point of all. $4.1 trillion in U.S. corporate debt matures by 2026. Foreign capital, once the default escape hatch, is no longer picking up the phone. Refinancing is getting harder. Risk premiums are rising. The cost of borrowing is climbing by the week. The first to feel the squeeze? Mid-sized companies, the middleweight backbone of American industry. Too big to pivot fast, too small to absorb shock. They're being squeezed from both sides. Shrinking lending, rising interest, and fewer places to run. So they're turning to junk debt, not because it's smart, but because it's the last option on the table. In 2024, $430 billion in high-yield bonds were issued. A 38% spike. These aren't expansion plays. They're desperation loans. Yields have spiked, from 5.2% in 2022 to nearly 10% today. For companies on the edge, it's lethal. In Boston, Hartwell Tech had just secured $180 million in equity, backed by Chinese capital. Overnight, it vanished. The firm scrambled to Apollo Global for a bridge loan. The rate? 11.3%. Backed by their IP, equipment, even their office furniture. Survival at a brutal cost. Fitch Ratings now warns, 1 in 5 mid-sized U.S. firms faces serious refinancing risk by the end of next year. Private credit is stepping in, but at a price. Control, covenants, collateral. The terms are ugly, and firms are taking them anyway. Because they have no choice. The age of cheap capital is over. And wasn't this supposed to be America's comeback moment? The era of industrial rebirth? Reshoring was the word. Rebuilding supply chains. Making things again. The 2022 Trump executive order gave out generous tax breaks for domestic manufacturing. It was supposed to be the beginning of something. But without capital, beginnings don't start. Factories don't run on slogans. Microchips don't fab themselves. Supply chains need fuel. And that fuel, money, is evaporating. What's happening now isn't a crash. It's not even a recession. It's something slower, stranger, strategic, a shift in momentum, a quiet, controlled constriction of financial flow. Not loud enough to cause panic, but deep enough to cause decay. China isn't playing by the old rules anymore. It's building a new board, with new partners and new stakes. And the US? It's realizing that economic power isn't just about how much money you have. It's about how much money people are willing to give you. That's the real leverage, and it's slipping. The air is tightening, not with sound or smoke or sirens, but with silence. The kind of silence that comes before a long, slow unraveling. Beneath the surface of the American economy, something fundamental is buckling. The headlines still speak in confident tones of rebuilding and reshoring, of resilience and revival. But the reality on the ground tells another story. One of frozen plans, vanishing capital, and a creeping realization that the comeback everyone was promised might never arrive. The numbers are stark. 62% of manufacturing firms that had planned to expand inside the United States are now facing funding shortages, according to the National Association of Manufacturers. Not because of domestic weakness, but because foreign partners, the very lifeblood of global financing, are pulling out, ghosting the American project in favor of quieter, more predictable bets elsewhere. The reshoring boom, once described in triumphant press releases as the start of a new industrial age, is dissolving under the weight of harsh fiscal gravity. An $8 billion battery plant in Michigan has gone cold. A $3.1 billion robotics hub in Nevada was canceled before it broke ground. Even the centerpiece of America's semiconductor renaissance, Intel's flagship Ohio facility, is halting its second construction phase, not for lack of will, but for lack of capital. These are not temporary delays. These are signals, and they are loud. Eswar Prasad, economist and former IMF official, didn't sugarcoat it. Without diversified capital sources, he warned, these efforts will be reduced to symbolic gestures. Grand announcements, groundbreaking ceremonies, photo ops with hard hats and shovels, but little else. No momentum, no foundation, no staying power. Just paper dreams that curl in yellow under the harsh sun of financial reality. At the same time, global supply chains, stretched, rewritten, and politicized, are now dragging costs upward. Every link in the chain adds pressure. Every dollar spent erodes what was once considered a patriotic vision of economic independence. It's not a strategy anymore. It's becoming a burden. And that burden is no longer confined to boardrooms or policy circles. It's landing in the shopping carts, bank accounts, and monthly budgets of everyday Americans. Trump's 2025 tariff expansion now covers more than $500 billion in Chinese imports, a sharp escalation from $370 billion just 5 years ago. The average tariff rate has spiked to 22%, according to the Peterson Institute. That surcharge doesn't vanish in transit. It hits where it always does, at the register. Electronics, appliances, car parts, essentials. Appliance prices alone are up 16.7% year over year, as tracked by the Bureau of Labor Statistics. And with Walmart and Target issuing margin warnings, the message is clear. Profits are shrinking, costs are rising, and the American consumer is the shock absorber. It's not just about what things cost now. It's about what life costs. The National Retail Federation estimates that by the end of 2025, the average American household will need to spend an additional $1,950 just to maintain the lifestyle they already have. No luxuries, no upgrades, just holding the line. Meanwhile, wages remain flat. The inflation rate clings stubbornly above 3.6%. And the storm clouds aren't receding, they're thickening. Corporate America is feeling the sting. S&P 500 earnings in the last quarter of 2024 grew a mere 1.2%, a steep fall from 4.5% just a quarter earlier. Companies are faced with a cruel binary: eat the rising costs, or pass them on to consumers already stretched thin. But passing the cost down doesn't just risk weakening demand, it risks snapping it entirely. When a family has to choose between a new appliance and paying rent, that's not macroeconomics. That's survival. And in the backdrop, a more ominous signal begins to pulse. Confidence, arguably the most valuable currency in any economy, is evaporating. The Economic Policy Uncertainty Index, maintained by Baker, Bloom, and Davis, has surged to its highest level in over a decade. Higher than the COVID lockdown panic. Higher than the 2008 collapse. It's not just volatility. It's something deeper: confusion at the top, fragmentation below. Unpredictable trade moves, incoherent fiscal gestures, tighter monetary policy with no map forward. A system that no longer seems to know where it's going. CEO confidence is cratering. The conference board's index dropped to 37 in March, lower than during the height of the pandemic. Nearly 70% of executives now list policy confusion as their single biggest obstacle to long-term planning. And the markets? They're not reacting, they're leaving. In the past 90 days, more than $120 billion has flowed out of US equity ETFs. Not because capital is too expensive, because capital no longer trusts the direction of travel. This isn't a liquidity crisis, it's a faith crisis, and as trust leaks out of the system like air from a tire, something else is happening quietly. Overseas. While Washington stumbles, other nations are laying down track. Germany's BASF just doubled down on a $10 billion investment in China, days after Chancellor Merkel returned from Beijing with a green energy partnership. France's economy minister signed an LNG deal denominated not in dollars, but in yuan. The European Chamber of Commerce is reporting a 19% surge in investment flowing into Chinese industrial zones in Q1 of 2025 alone. Their reason? Stability, predictability, clarity. Saudi Arabia, long a loyal buyer of US treasuries, has begun redirecting its funds. $27 billion has been committed to a joint AI development fund with China and Singapore. The message is clear. The gravitational pull of American soft power is weakening, not vanishing but softening. Allies aren't defecting, they're hedging. They're preparing for a world in which the United States is not the only game in town. And China? China isn't posturing. It's building. The investment freeze that shook Hartwell Tech wasn't just a strategic retreat, it was a signal, a pivot, a declaration. The China Securities Regulatory Commission has fast-tracked 38 IPOs in Shanghai and Shenzhen this quarter alone, a 52% increase. Beijing's sovereign wealth fund has funneled nearly $20 billion into ASEAN bond markets. According to a leaked HSBC report, this isn't scattershot, it's coordinated. The most ambitious piece? The digital yuan. Already operational in SWIFT-Lite systems across 13 countries, it enables real-time cross-border settlements that completely bypass the dollar. This isn't about overthrowing the dollar overnight. It's about creating a world where the dollar is no longer the default, just one option among many. As HSBC's Harold Wong puts it, this is about gravitational pull, not confrontation. A slow, silent shift in orbit. And if capital keeps drifting east, Wall Street may wake up one morning to find the money already gone. Quietly. Permanently. If Beijing can redirect global liquidity, choke off American markets from the inside, and rewrite the rules while everyone else is distracted, then the real threat isn't invasion or sanctions or war. It's erosion of trust, of influence, of primacy. This freeze, this tightening grip on the arteries of American finance, it's not just an economic tremor. It might be the opening move of a larger, colder endgame. One where the dollar's dominance is not shattered, but simply abandoned. Not by enemies, by friends. No explosions, no declarations. Just a quiet decision in a faraway boardroom to stop settling trades in dollars. And just like that, the system we've known doesn't crack. It quietly disappears.